Well, thank you all for joining us today for our market update webinar. Very excited to have all of you on today's webinar. We had a lot of things to talk about that has been happening this year and still has yet to happen for the year. Looking forward to it. Also, I want to thank everyone for sending in your questions ahead of time. Definitely helps with some of the material that we're going to cover. And also, if there was a question that we didn't get to, we will look to answer that on our podcast, which will be released next week. So you'll have some additional listener questions that we'll answer on the podcast. Yeah, for those of you that aren't familiar, you can check us out at keenwealthadvisors.com under retirement resources. We've got our podcast and blog and also the webinar. We list upcoming webinars and also all the replays, so you can check those out. Some of them are market update related, others are financial planning focused, tax focused, policy, what's pending, what's coming down the pipeline here. So a lot of great things to focus on. Also, if any of you would like a copy of Mr. Keen's Amazon best-selling book, Keen on Retirement, Engineering the Second Half of Your Life, please, shoot me an email or anyone on our team. Reply to any of the emails that you receive from us. My email is mwilson@keenwealthadvisors.com, and we'll get a copy sent out to you. And then lastly, we've got our new YouTube channel, and we've been posting our webinars on there, and also it's very, very close to being ready, but when we have the video versions of our podcast listed on YouTube as well. So if you haven't subscribed to that channel, check that out, youtube.com/KeenWealthAdvisors, and you can subscribe to that to get updates. Okay, let's talk about the markets. I always like to start the webinar with information about, okay, well, what have the overall markets, what have they done? And it's interesting you say markets. It's like, well, what market? I mean, there's a lot of different asset classes, and there's different investment strategies and styles. Now, these are the major indices. So we've got the Dow Jones, the S&P 500, the NASDAQ. Those three represent primarily large publicly traded businesses headquartered in the U.S. Dow Jones goes back a very long time. It's 30 of the what they consider the industrial companies. S&P 500, a little more broad-based, 500 businesses, and then NASDAQ has more on the technology side than the other two indices. In addition to that, though, we also have benchmarks here to measure small companies, emerging market companies. So these are companies that are headquartered in countries that aren't developed yet, but are in the process of developing. And then we have international companies, so large companies, though, that are headquartered overseas. Well, so far this year, the U.S. has done very well. S&P 500 up 22%, NASDAQ up 21%, emerging markets up 14%, Dow Jones up 14%, small companies up 11%, international large companies up 8.7%. So the reason I point this out is because while the S&P and NASDAQ have done well, a lot of that's been driven by technology. The tech sector has been a strong sector, been performing well for several years, and it's going to reflect in those benchmarks, those indices. When technology is a large portion of those holdings, well, then they're going to perform well. When technology is not performing well, it's going to have the opposite impact. Looking at it from a sector standpoint, it has been an interesting year. So while I said technology's done very well, you can see it's up 21% this year. You've got now communications, a lot of that people might consider as a technology type company. Those can be communications companies such as Meta or Facebook, kind of falls in that category. But financials have done well. Some of that driven by interest rates, utilities as well. And utilities is such a small percentage of the overall benchmark. So even though utilities are up 31%, it represents maybe 3% of of the S&P 500. So not a large sector, but a sector that has been performing well. Energy has been struggling compared to the rest of these other sectors. Now let's moving over to interest rates. Here I've got the yields on fixed income that is issued by the United States Treasury. So this is government bonds, and all this has factored in is it's just reflection of interest rates. The U.S. government is considered essentially risk-free. While there's a credit rating, the U.S. government has never defaulted on their debt, and it's never expected for them to default on their debt because they could always raise taxes to pay the debt if necessary. Interesting year too when it comes to yields. So this black line is the 2-year Treasury. Was climbing for first few months of the year, and then it started to drop down. Hit a low here in end of September, and now starting to climb back up again. We're about slightly lower than where we started the year, but not that far off. But considering it went up to nearly 5%, the 2-year Treasury is now at 4%. 5-year Treasury also at 4%, and then the 10-year Treasury 4.2. So able to get a little bit more interest by going out and purchasing longer term bonds. Well, interest rates fluctuate by supply and demand. So there's the Federal Reserve controls what's called the overnight lending rate, and that's the rate that they charge institutions to borrow from the Fed. And that does kind of set the stage for all the other interest rates. But these interest rates, the U.S. Treasuries, aren't just set by the Fed. They're determined by participants in the marketplace buying or selling these bonds. So if there's a lot of demand for them, more so than supply, well, then yields come down because there's a lot of people purchasing the bonds, which then drops down the yield. When there's less demand and more supply, well, then there's more people selling them. And to entice people to sell them, you have to lower the price, which in essence raises the yield. So we're in a period now that people are dumping treasuries. So there was a period here before that where there was a lot of demand, less demand, and yields are going back up. Reflecting a few things that's going on. I'm going to talk about the inflation data and the Federal Reserve's outlook here in a few slides, and that's really what this is kind of reflecting. This is the performance of various bond maturities. And when you have a bond, and especially a government bond, you're not worried about default risk. U.S. government bond, as I mentioned, really has no default risk. So now it's all just what we call interest rate risk. So it's when you own a bond, it's the performance of the bond, if you hold it to maturity, is just going to be the interest that you receive. But if you need to liquidate that bond prior to maturity, well, then it's going to fluctuate. The value of that bond is going to fluctuate based on interest rates. And that's that interest rate kind of risk. The other interest rate risk is the reinvestment risk. So it's like, okay, you can get this yield today, but in a year, 2 years, 5 years, whatever future time frame, we don't know what interest rates are. So when they mature, are you able to achieve the same interest rate? That's another risk that is associated with bonds. Looking at this chart, this red line, well, that is very short-term government bonds, mature in less than a year, and it's just kind of a straight line, similar to money markets. Fluctuates very ever so slightly, but up 4% so far for the year. And then as the color's going to go down, you can see performance varies, and that's primarily based on how long until maturity. So the longer term bonds, TLT, those are US government bonds that mature in 20 years or more in the future. They're down 3.8% for the year. At one point, up until when interest rates were falling in May, and then hit a low point there at the end of September, those 20-year bonds were up almost 5%, and now they're down nearly 4%. So they have a lot of fluctuations around interest rates. We focus more on shorter term bonds because we want the stability and not necessarily the volatility that's associated with longer term bonds. Well, let's talk about the economic environment. These are the several leading indicators. There's a whole slew of leading indicators. These are ones I like to focus on and have been focusing on these for several years in our webinars. Number one, first and foremost, I think that in my view is the most important indicator is the state of the jobs market. That helps us determine a lot of different things, but we're in a consumption-based economy here in the US. And so businesses are, 70% of GDP, all the money that's spent every year, is on consumption, which is what us as individuals spend our money on. Then there's a portion that businesses spend. So that's about 20%. Then there's government spending. So that's what does the government do? And that's another smaller portion. And then there is the impact of trade, exports versus imports, which actually is a negative on our GDP because we import more than we export. But by and large, the largest portion of GDP is consumption. Well, if people have jobs, they're more likely to consume. They're going to spend money, which is going to then in turn show up as revenue in these businesses they spend money at. That kind of flows through the all the financial statements and turns into earnings, and stock prices are a function of earnings. So that's why I focus on this, because if there's weakness in the jobs market, well, then we could expect to see a slowdown in revenue and earnings and maybe a drop in stock prices. Jobs market has been very resilient. This is going back pre-COVID. There was the pre-COVID high. We're now surpassed that. These gray bars, anytime you see those on any of my graphs, that represents a recession. So that's the COVID recession. But 159.1 million jobs here in the US. There's also 8 million in job openings. That's been pretty steady last few months, but it's been dropping down. Still higher than the pre-COVID area. So still employers are still needing workers. We also have, another thing that we look at is unemployed workers. So this is initial claims. So these are folks that are laid off and then file for unemployment and then continue to file for unemployment. And you can see it's been very steady. Pre-COVID, 1.8 million. At the peak post-COVID, 23 million people on unemployment. Now we're back to 1.8. It's been 1.8 for quite some time. And that's been, it's been steady. If we start to see that spike, well, then there's maybe some indication that there's some weakness in the jobs market. Retail sales are strong. People are still spending money. We've got building permits. So these are new housing units. This it was been on, I would say, a very similar trajectory, kind of post 2008, 2009. We had our COVID drop and then COVID spike, and now it's starting to normalize a little bit. Higher interest rates has slowed it down, but it hasn't crashed the housing market. That was a big fear, was that housing was going to crash with higher interest rates, and that definitely has not happened. Business spending, been very steady here last several years. And then lastly, the yield curve. So this is looking at the spread between the 3-month government, it's actually called a bill instead of a bond when it matures in less than a year. So that's the T-bill, 3-month T-bill, Treasury bill. And then you have the 10-year Treasury bond. And when this line is below the dark bar, that tells us that short-term interest rates, the 3-month T-bill, is higher than the 10-year interest rate. That's what's called an inverted yield curve, meaning you as an individual or business is incented to keep money more liquid in more shorter term interest-bearing investments because you aren't compensated for going farther out. So buying a 10-year treasury actually pays you less than what a 3-month treasury would on an annualized basis. Now, you've got to make a lot of decisions when you factor that in, because it's like, well, just because it's paying less, you're locking it in for 10 years. So where do you think interest rates are going to be between now and 10 years in the future? Do you think you're going to have an opportunity to lock in a 10-year treasury at a higher rate or not? These are all things that we think about when we allocate capital for our clients. But this inverted yield curve, this gets a lot of airplay. It's been interesting here over the last decade, but prior to this last decade, an inverted yield curve was a very strong indication that there's going to be weakness in the economy in the future. I mean, we can always say that there's going to be weakness at some point in the future, but in the, I would say, more immediate future, next 6 to 18 months, because inverted yield curves have preceded recessions in all of these circled areas. There's the gray bar, inverted yield curve happened before that. There's the recession. These two, this last decade, well, you had COVID. Well, I don't think the inverted yield curve predicted COVID. So, some things around that are slightly different. But then post-COVID, we've had a lot of different participants in the fixed income market doing some things, such as the Federal Reserve with their quantitative easing, quantitative tightening, where they have manipulated interest rates. I mean, they have been public with that was their goal with those different quantitative strategies, was to reduce interest rates or increase interest rates. So lately, they have been, we call it quantitative tightening. They have owned a bunch of bonds that they have bought over the years, post 2008, 2009, and had let those mature. So that is kind of putting more funds back out in the market, more supply, which would raise interest rates relative to the demand that's out there. That isn't, when you have participants that are utilizing things like that, that isn't necessarily a reflection of just what's happening in the overall market, because you have a participant that's doing something that isn't reflective of the economy. Whereas these previous inversions, the Federal Reserve wasn't active in the fixed income markets to the extent that they have been post 2008, 2009. So just a little caveat on the most recent inversion. Now let's talk about earnings, corporate earnings. As I said earlier, stock prices are a function of earnings. And I put together my market multiple every quarter, and it looks at earnings estimates now and in the future. These are S&P 500, so it's taking all 500 companies and their relative weighting in the S&P and creating the earnings per share based on that weighting. You can see going back to 2014, what the dark shaded in lines are the actual earnings for that year. The non-shaded in lines, those are estimates. So we've got 2024, because 2024 is not over, and we won't have the final numbers for 2024 until Q1 2025, when earnings are released for 2024. And then we've got the estimate for 2025 here. 2026 estimate is also, I have it listed over here, $311. And the reason I list that is because as we enter 2025, the market is pricing in future earnings. So the market is looking ahead, and it's a discounting mechanism. So market looks ahead and says, okay, what are those earnings worth today, and discounts them, in today's future. And what's the every day there's this discounting mechanism, because it's like, well, hey, economic data comes out. Well, is that going to impact earnings in a positive or negative way? What impact is that going to have? And participants adjust their views and their allocations and their weightings every single day, which is why prices fluctuate. Over long periods of time, though, it's like it always comes back to earnings. Are companies making money or not? So the reason I list 2026 is because, as we enter 2025, year-end 2025 is going to be based on 2026 earnings, just like year-end 2024 based on 2025 earnings. So let's look ahead at the next 12 months. And, if we're looking at the 2026 earnings of $311, these are estimates put together by analysts. We can take that $311 and we can compare it to our current price of the S&P 500. So the current price, 58.51 of the S&P 500. And we apply multiples. 18 times multiple, a 20 times multiple, or 22 times multiple, even potentially a 24. We could go as low as 16 or 14. I mean, these multiples aren't set in stone. They're just a function. They're a function of interest rates. They're a function of clarity into the future too. So the more known something could be in the future, potentially the higher multiple it can have. The less certain, then the lower the multiple can be associated with that. So just something to think about when you're looking at these market multiples. Now let me go back here on this slide, because I want to show this, because let's just say if 2024 ends at $239 a share, just to kind of give everyone some perspective, current price of the S&P 500, this was as of the close on October 22nd, 58.51. If we take 58.51 divided by $239 a share, that gives us a 24 multiple. So I mentioned these are the ones that I've been using for some time. Market's currently at a 24. And the higher the multiple, the higher the projected prices for the future value of the S&P 500. So given this range over the next 12 months, low end, market could be down 4.5%, up to 14.4% over the next 12 months from the current value of the S&P 500. These are ranges based on things progressing in a way that makes sense based on the data that we have today. So as the data changes, of course, we would adjust our view and our outlook. But on the low end, we'd have to start seeing more weakness in the economy and the economic data for the market to discount earnings at a lower multiple. Meaning there's more uncertainty about the ability of the market to achieve this earnings result if economic data comes in weak. If economic data stays the same or comes in stronger, that's where then higher multiples start to materialize. So that's how these market multiples work and how to think about it when we're providing these price targets. Let's talk about interest rates here. Interest rates, the Fed reduced them by 0.5% at their most recent meeting, and the current range is 4.75 to 5%. And by year end 2025, the market is anticipating or pricing in a 3 to 4% range. So lower than where they're at today. And we'll see. I mean, that's been, I think, one of the things that has been a slight surprise, especially since the beginning of October, was the strength in the economic data. GDP continues to be very strong, and the jobs market came in much stronger than anticipated. So when that happened, when that data was released, when interest rates started to creep up in the treasury market, meaning people started to think, well, maybe the Fed isn't going to lower rates as much as they said because the data is stronger. So that's where we're seeing a little bit of a change in the direction of interest rates over the last few weeks. CPI, though, has come in much better. 2.4% is where the year-over-year inflation data is coming in. Headline CPI. So this includes food and energy. You can see energy has been a detractor. Some core goods have been a detractor where, either shelter, housing, spiked. It continued to spike. That was kind of post COVID, and then it's been coming down. While auto insurance has been inflating at quite a clip here. So while prices aren't coming down, they're accelerating at a lower pace than they were a couple of years ago. And, that's a big component to the Federal Reserve and their outlook and what's going to happen as well. We got several questions about the election, that is coming up here in very short order. Well, here's kind of the economic and kind of market outlook around it. I mean, I think the markets are pricing in potentially a Trump victory. I think that's kind of what the data is pointing at currently. Now we know the data will change a lot between now and the next few weeks, but primarily, split government is really looking like that's going to be the situation no matter who wins the presidency, which is, from a investment standpoint, an indication that things aren't likely to change on a significant basis. So while it doesn't eliminate, it doesn't mean nothing will happen. It just means less likely. Now, one of the downsides of that could be then what happens with the Tax Cuts and Jobs Act, which is set to sunset or expire at the end of 2025. Because if we have a split government, well, then they may not come to an agreement. And that just goes back to the way it was prior to 2025, or prior to 2017 when that was passed, and taxes would go up. But the big policy, the big positive is most likely no radical changes. And it is looking like both candidates are heavily, they've been talking a lot about with their potential policies around the Tax Cuts and Jobs Act and not any significant changes to that. So more to come, especially kind of post-election. We'll have clarity on who the president is, of course, the makeup of Congress, and the potential for some significant policy changes that could impact the investing environment or all the financial planning stuff that could change because of that as well. The there's a lot of studies done on the fiscal impact of both of their kind of campaign plans for both of the candidates. So this is just, it kind of puts out, the candidates put out their plans, and the government, some of the different organizations are able to review those plans and kind of come up with an estimated fiscal impact. So you can see, I mean, between the difference between Harris and Trump, kind of there's definitely a lot more fiscal impact on the Trump potential policy changes versus Harris. But also, there's some kind of different things that would happen. Now, the likelihood of all of this happening is basically zero, because again, a lot of this has to go through Congress. There's very few things that would have to go through Congress, but significant tax changes would. Um, Under the Harris plan, as I mentioned, even she's talking about the Tax Cuts and Jobs Act, and really kind of keeping it the same for households earning under $400,000. Home buyer tax credits, exempting certain income from taxes such as tips. There's been talk of no tax on Social Security, things like that. This increasing tax on capital gains and unrealized capital gains. We did a podcast on that. Highly, highly unlikely for that ever to pass. And I think that while it'd be great if they could figure out a way to not tax Social Security, I don't believe that will happen. Just considering that the state of the Social Security trust funds is in a place that a tax cut wouldn't probably help that. From that standpoint. From the Trump side of things, he would extend everything that he had already passed under his previous administration with the Tax Cuts and Jobs Act. But one of the things, though, that would change would be eliminating the cap on state and local tax deductions against your federal tax bill. That definitely hits folks that are in high tax areas. So when you pay a lot of tax to the local government, to your state, prior to the Tax Cuts and Jobs Act, you're able to basically offset your tax paid at the government level, at the federal government level, and they capped that back in 2017. So eliminating that cap, exempting overtime from taxes, tips from taxes, Social Security from taxes. Again, I think, while sounds good, the Social Security side will probably be difficult. Providing some tax benefits to corporations, things like that. The tariff, that's been a lot of talk on that. I'm not quite sure that can happen without Congress being involved, so the president can do that. So just definitely something to keep on our radar, what that would look like, and the policy changes related to that. It does seem highly likely that the Tax Cuts and Jobs Act, while could be some minor changes depending on who wins, I think there's going to be an extension of that in a lot of the ways that we expect it to be today. One of the things, though, both of these policies, should everything be passed that they've proposed, again, which is very unlikely, there is, it's considered pretty stimulative. And when we have low employment, we're in a low employment environment currently, that can just continue to lead to more inflation. The inflation that we experienced over the last few years, I believe, was more tied to the situation with COVID and the supply chain and everything else, less necessarily tied to like specific stimulus, where people during the COVID period were, they were at home, and it was easier to spend money working from home online. There was, government stimulus that was given directly to households, and that money, made its way into into businesses, but they didn't have supply, and so that was kind of raising prices. Similar with real estate too, a lot of that I think was impacted by it. This type of stimulus, not quite as impactful when you have a tax cut related stimulus or a business kind of tax cut related stimulus. Those aren't just those funds aren't just ending in the hands of consumers to just go spend. It's slightly different than like a transfer payment, which is kind of what the government did, where they're transferring money directly to consumers to go spend. That's just slightly different. So I don't believe that the inflation that would be created wouldn't be nearly the same inflation that we saw over the last couple of years. Now let's talk about the outlook. Kind of what do we see for the rest of this year, and what do we see going forward into 2025? And there's never a time where everything's perfect. We've got issues, one of them being investor sentiment. And I say it's an issue, it's because when investors are greedy versus fearful, that can be what we call a contrarian indicator. Valuations, like we're trading right now at a 24x multiple, like that's current. The S&P 500, if the earnings come in where they're what the estimate's at, 239 divided into the current price, that's current multiple of 24, which is pricing in a very optimistic scenario, slightly elevated. Recession predictors, while things are still good, there's some weakness in certain areas. Affordability of homes and other things, I mean, that's going to cause some problems. And then there's almost always geopolitical issues that can just be a surprise, a shock to systems that just come out of nowhere. From a investor sentiment standpoint, this is a fear and greed index. It's on CNN's website, and they just look at different market metrics and come up with this more as like an algorithm. And it is on a greedy side, and it has been for a month or so. But a year ago, extreme fear. And over the last 12 months, the stock market, the equities, they're up 30+% over that period. So when I say contrarian indicator, it's like, yeah, when this said extreme fear, it's like, yeah, that was a great time to be buying. It doesn't mean it's going to go right up instantaneously. You have to give it time, but a year in the future looks very strong. Now, this doesn't mean that a year from now it's going to be down 25% because we're in the green area. It just, depending on what happens, maybe the market goes sideways for a little bit, bounces around. That's kind of my scenario where I said if some of the economic data is not as strong, we have a pullback of 4% in the next 12 months. It's definitely possible. I say a small possibility, but it's definitely possible. Valuation metrics, current PE, I said 24, forward PE 20, 22, kind of looking at earnings estimates over the next 12 months. That's what, when I use those projections, that's where we're at. You can see 30-year average, a 16.7. Now that includes market pullbacks that were significant in the year 2000, 01, 02. We also had 08, 09, the Great Recession intermixed in there where prices came way down. So the average is going to be, I think skewed a little bit because of that. See the standard deviation. So from a 30-year period standpoint, it may be slightly elevated, but I don't think PE ratios are the end all be all. If you're always just basing everything on the market multiple, there's definitely some other factors at play to take into consideration. Recession fears. What this is, the NBER, that's the National Bureau of Economic Research, and they are the organization that makes the call on whether the U.S. is in a recession or not in a recession. The variables that they use, real personal income, so that's net of inflation, payroll numbers, household surveys, consumer spending net of inflation, wholesale and retail sales net of inflation, and industrial production. And this is a heat map. So when things are red. This is COVID, and you can see that red block. That was COVID, and then green, post-COVID. And then since then, there's always little periods and pockets where some things are doing better than others, but they're not terrible by any means. But there can be some weakness from time to time show up in some of this data. There was definitely a little bit of weakness in some of this in 2022, but not enough to say there was a recession. Something we keep a close eye on. Housing affordability, these are inventories and housing starts and vacancy rates. I mean, housing is just, there's not enough inventory to meet demand. And in certain areas that have high density from a housing standpoint, there can only be so many houses that can be built and created. So I think housing is going to be just a continued kind of issue across the U.S. especially for first-time home buyers, and that's part of the proposals under the different candidates. They both have different things for first-time home buyers. While great, that may not necessarily address the fact that housing is expensive. Interest rates are higher, so that's a component. But then too, just the price to purchase. This is median sales price across the United States. And it's been stagnant here going back to 2022 as interest rates spiked. But it, again, as I mentioned, didn't crash. Nearly 440,000 at the peak, and then, slightly below 420,000 currently. So more of a flat line than I would say a crash, but kind of post-COVID, you can see significant increase in the median sales price of a home. But despite the issues, there's a lot of positives. I mean, we're in a bull market currently. And just because we're 2 years in, this is going back to 2022. That was a reset. Market dropped 20% or more in 2022. NASDAQ dropped over, 30%, the tech side of things. And that signals a correction, which resets the definition of a bull market. This, you can barely see it on here. It's green right here, October 22 to current. There's the green line right there. And you can see all these other periods of bull markets. So just because we hit 2 years doesn't mean it's over. There's can be a lot left. The market dynamics too. So what this is, this red line is the S&P 500. This is the performance for the first 6 months of the year on the left side. On the right side is from mid-year to today. And the reason I'm showing this is because the blue line is what's called the equal weight S&P 500. So the way the S&P 500, the 500 stocks that are in there, they're weighted by market capitalization. And market capitalization is a formula where you take the stock price, current stock price, times the number of shares outstanding. And that gives you the market capitalization. And that's a proxy for the size of the company. So when you hear that a company is a $1 trillion company, well, that's the market capitalization that they're referring to when you hear that. So the higher the market capitalization, the higher the weighting in the S&P 500. And you might have heard too that there's the magnificent seven, and basically the top 10 stocks. I mean, the Mag 7 is related to the 7 largest stocks, but they change. There was the FANG stocks, and then there was the FANG M stocks, and then there was, different acronyms to represent the largest companies. But if you really kind of think of it, it's just really the top 10 companies have had a larger impact on the performance of the S&P 500 in the first half of the year relative to just taking all 500 companies and weighting them exactly the same. So the largest company and the smallest company all get the exact same weighting. And that's what this blue line represents. So you can see the blue line for the first 6 months of the year was only up 5% versus the red line was up 15, kind of indicating that the larger companies were performing better than just the average company. Since mid-year, they've both done well, but we're seeing a little bit better performance out of the rest of the companies in the S&P 500 compared to the largest. And that's a good sign. That means things are spreading out. It's not just a few stocks that are driving things higher. Interest rates too. The Fed, they have their year-end estimates in this blue line going to year-end 2026, and the market expectations are right in line. Looking at anywhere from a drop of a couple of percent from where we're at today, 1.5 to 2% by the end of 2025. And that's a positive catalyst when interest rates are lower, typically for stock prices. Money is considered loose. It's more available. It's easier for people to access loans because the payments are lower. People aren't incented to lock money up in CDs or treasury bonds or money markets because the interest rate isn't nearly as good. So it incents people to invest the money or spend the money, go do something with that money. Inflation's been coming down. We have headline and core CPI. Employment has been strong. This is employment aged 25 to 54. I mean, nearly as high as it's ever been. Very, very strong employment numbers. GDP been stronger than what a lot of people have expected. There's the 70% consumption at 68% consumption, government spending, business spending, housing. You got the impact of our imports and exports. Yes, but GDP has been good. Consumers are in great shape too. Household net worth continues to hit all-time highs. Assets are increasing. Liabilities, while yes, they do increase over time because the numbers are larger, they aren't nearly as increasing at the same rate that assets are. Household debt service isn't putting a squeeze on consumers. So people are feeling good, They're not having to pinch pennies by and large. Now, as I mentioned, not everything is perfect. And one of the things too that has been ramping up some delinquencies on autos and credit cards. That isn't necessarily the end all be all, but that is a something that we do take note of, because if folks have issues paying their bills, and then all of a sudden we have some weakness in the economy, so that by and large isn't necessarily an issue. But where this becomes an issue, where a lot of things aren't necessarily problems, but when they become problems is when we start to see weakness in the economy and we start to see job losses. Again, it's kind of taking it back to why the jobs market is so important, because some of these things can be an issue, but it's not a problem until someone loses their job. Because once they lose their job, then we start to see delinquencies spike significantly. We start to see issues that aren't necessarily big issues today, but turn into major problems because now income is gone and now can't make the payments anymore. Delinquency isn't necessarily, it's 30 plus days late, but still making payments. So the path higher over the next 12 months, economic growth has been strong. We're going to watch if that's going to continue. Again, continue to watch the jobs market. That data is released every single month. We also have weekly initial claims. So when people file for unemployment, that data comes out every single week. So high visibility into the jobs market to kind of see what the economy is doing currently and what our projection is. Also earnings. The projections from the analysts, they've come down slightly since the last webinar, but not significantly. But what, again, the market is kind of discounting future earnings back to today. So not necessarily as concerned about current earnings. Yes, that is something to take into consideration, but it's also future earnings as well. Inflation. Inflation has been at a point to where it's come down enough to be less concerning, and so much so that the Federal Reserve decided to cut rates 0.5% at their last meeting. We'll see what they decide to do in the future, but considering since then GDP's come out, been stronger, we've had positive job numbers, things like that, the fear or the market has been thinking, well, maybe inflation isn't as slow as the data is indicating, because if things are good and people are going to start spending more money again, are we going to see an uptick? So maybe the Fed isn't going to reduce rates as quick as they have indicated recently. And of course interest rates, yes, because that does factor into our market multiple. The options that people have as investors, is kind of, well, if I can earn owning a government treasury, if I can earn 5%, is the incremental return by owning stocks worth the volatility? Now, what no one knows is there's no guaranteed incremental return. So what is that incremental return? So we don't know what that is. It's always an unknown. Over the last 12 months, I said, north of 30% on the stock side. And the bonds are up because interest rates have come down. Depending on the bonds, they could be up I've seen anywhere from 5 to 8%. But you're looking at a, significant delta there of almost 22% by owning stocks. So where do we go from here? I'm big into data and looking at historical data, cycles. When certain things have happened, what has happened in the future? When the S&P 500 returns, when they're up 10 of the last 11 months, and this just came out in October, this is a strong indication that the positive momentum will continue. Momentum is it's a factor in the stock market, just like the multiple. That's a factor. What's the price that we're paying for a stock as a multiple of earnings? Typically lower multiples have been connected to future higher returns. Momentum as a factor. When prices are trending higher, they tend to continue to trend higher. Like these are all study phenomenon within the market. When we have this positive momentum typically continues next month, next 3 months, next 6 months, next year. In the previous times that this has happened, it happened previous 10 times, 9 of them have been higher, with a median return of 13.4%, which is right in line with the 14% return that I have on the market multiple, kind of indicating I think a lot of things are trending in that direction. Well, I want to thank all of you for joining us on the webinar today. Again, appreciate all of the questions that you submitted ahead of time. There's a chat box too if you'd like to submit any additional questions. We're at the top of the hour here, but we will definitely do our best to answer those on the future podcast episodes. Again, check us out, keenwealthadvisors.com, if you have not already subscribed. If you'd like a copy of Bill's second edition, or if you'd like us to send a copy to someone, please let us know. We're happy to do that. And then lastly, our YouTube channel, we will put a replay. We're going to send the replay to everyone who signed up for today's webinar, but also will host the replay on our YouTube channel, youtube.com/@KeenWealthAdvisors. Again, thank you all for joining us, and we will see you soon.